Good evening, everyone, and welcome. I'm Shelley Palman from Enable Me, and I'm here to talk to you tonight about being less stressed about your mortgage. I wanted to start with a question, and that is, how many of you listening tonight want to care less about the OCR and where it sits? How many of you listening want to care less about interest rate fluctuations and how banks make mega profits at the expense of Kiwi homeowners? I'm here to talk to you tonight about how to control your mortgage debt to unlock more options and more freedom in your life. Paying off your mortgage, it isn't just about deprivation, it's about making strategic steps and progress so you can worry less, feel in control, and work your way step by step towards financial freedom. So, a little bit about me and why I'm qualified to talk to you today about mortgages. Well, I've been talking about mortgages to clients for 10 years. I have helped many, I would say in the hundreds of clients get mortgage free. My role is helping people to optimize their situation to get better outcomes and move forward. I never judge past decisions. I work with my clients to find those inefficiencies in all areas of their finances and use these little incremental gains that we find to get them ahead much faster, which results in less stress. Tonight, it's all about progress, not perfection. Becoming financially free, and I'm going to talk about financial freedom a little bit later, it's a journey. It's not something that happens overnight. It's not a shampoo ad. It's the best way to gain exponential results is by working with a coach, stretching you to be better. So, important note, tonight's presentation is purely educational. I'm glad you're here. I'm glad you're listening, but it is not personalized financial advice. You can take these concepts and you can apply them, ideally with the right professional support. So disclaim. I wanted to start off with a quick poll because I wanted to get a quick pulse check of where we're at in terms of our mortgages. So hopefully producer Amy can pop that little poll up on the screen and you guys get to tell me who I'm talking to tonight. So there's no right answer. This poll just helps me tailor the conversation to you guys once I know where you're at. Mortgage free doesn't necessarily mean stress free and vice versa. Like I said before, progress is in favour of perfection. So hopefully we've got some of you on here who are mortgage free. Maybe you have some investment property debt. I'll give you a couple more seconds to answer. And the results are, yep, this is a mortgage payoff webinar, so no surprise. More than half of you, just over half of you, have more than 15 years to go on your mortgage. So I'm very sorry about that, but listen up, because this is why you're here tonight. I'm just going to close that off. Okay, fantastic. Let's get started. So financial security, why would we want that? For me, it's that sense of peace of mind. It gives you the ability to have choice and options, and it can help you to remove stress and feel more resilient with your money. Really, financial security, it's not necessarily about stopping work, but it's having the choice maybe to do so if that's what you want to do. In my mind, money is just a tool to support the type of life you want to lead. So what we're finding at the moment, it's noisy out there. There's a lot going on. Things are happening, wars, interest rate increases, OCR announcement, markets are volatile and fluctuating all over the place. Inflation is tipped to increase. The one common thing with all of these things, none of them are within your control, none of them. So being informed about these things is really good, but the paralysis of doing nothing is really not good. People get paralyzed by the noise and the media and what's going on. We need to be in a space where we can push that aside and take action. And actually, hope comes from focusing on what you can actually influence within yourself and moving away from fear. So reading those headlines and going down that rabbit hole of all of the things that we can't control, really not helpful. And I know it's hard to ignore, but it's not helpful to take that stuff on. So we need to be thinking about the things that we can control. So a lot of you, and if you've got a mortgage, the OCR is something that you wish you didn't have to know about. There was an announcement recently, it stayed at 2.25%, which is good. So the headline didn't change, but the context did. The OCR and what happens with it, what it's doing is it's signaling direction. It doesn't actually dictate what the banks do because lending rates are influenced by global markets, the cost of funding, inflation, bank margins. A little bit of a mystery to me how they work it all out. It's not just the OCR. But what has changed is the inflation backdrop. So a little concerning because we've got this Middle East conflict, we've got higher oil prices, there's a massive disruption in the supply chain, and this looks to push to inflation expectations up. So the Reserve Bank is now forecasting inflation lifting quite a lot. That actually matters to us because persistent inflation, keeps interest rates higher for longer, which affects us mortgage holders. And we know now that rate cuts off the table in the near term. If the plan relied on further falling of interest rates, I would challenge you and say it's time to stress test that assumption. This is where people can get a little distracted, watching the OCR announcements, instead of focusing on actually what they can control, what's going to move the dial to get the better outcomes for them. So I would argue that the real question isn't what happened to the OCR at the last announcement, it's does your financial structure still work if rates stay here or edge higher? That's why that fact that you're watching this webinar tonight actually matters, because getting mortgage free is based on having strong financial foundations and good structures, not by you trying to guess the next rate move with the banks. So uncertainty, it's not a new thing. Actually, it's the normal financial environment. Things are constantly fluctuating and volatile. What causes problems isn't volatility, it's lack of preparation and lack of taking control of the things that you can control. Having a clear financial plan actually gives you something to anchor to when things get really noisy. Okay, I've got this going on. I'm not going to go down that rabbit hole and think about where the fuel ships are. I'm actually going to think about, right, what are the things that I can do today? Sit down. What can I change about my situation and my habits and my structures to make myself in a better position to be able to get ahead? So a good plan gives you that anchor. When we start to feel emotional and the headlines are spiking and triggering you, we've got a plan, we stick to that plan regardless of what's going on around us. I think we need to get clear that we should expect things to fluctuate and be volatile rather than for things to be certain. So, speaking of focusing on what you can control, well, let's get clear on your starting point. Let's define the problem that we're trying to solve. Have you got a cash flow issue? Just not enough money. If you do have a cash flow issue, does that relate to your income or does that relate to your expenses or a little bit of both? Are you in a situation where you can't afford your life anymore and we need to make some strategic change to improve your cash flow? Is one of your issues that you're running out of time? We like to call it the runway. So how many years of your working life do you have left? That is your time frame for making change. And what is the risk that you need to take? I would argue that habits and structure beat predictions every time, but you've got to understand where you're starting, the problem that you're trying to solve, so we can start to overcome that problem. So that's where we start. Those are things you can control. So where are you starting from? If you're sitting in front of me and you're listening to this tonight, do you have short-term debt? Can you pay your credit card off every month, or is it starting to linger? If that's the situation for you, then I would say that you are sinking financially. Sorry to say. You should be able to pay your credit card bill off every month. And in an ideal world, we don't actually have one or use one in the first place. But if you're finding that you're tracking a little bit backwards, you've got some short-term debt and you're struggling to make repayments, you're sinking. That's your starting position. If you're floating, that kind of means the paycheck to paycheck thing. We want everyone to get to flying. We want you to be in control, resilient, and actually making progress in the right direction. We also all have these natural money tendencies. So Some of us identify with the more shopper or spender persuasion. Feels really good in the moment of the spend. When you swipe that card, you get that little dopamine hit. If that's the case for you, you're a shopper. If you're a saver, you actually feel a little sick when you go to pay for stuff. As you're putting your card down onto the card machine, you vomit in your mouth a little. It doesn't feel so good. You're a saver. But most of us can fall under that kind of that in between, that plodder. We want to save, we have the best intentions of saving, but we're really not doing it. We're just living paycheck to paycheck, and we're blaming the outside world and not earning enough and cost of living. And yeah, I know it's hard, but we've got to get more focused when you're a plodder. So that's your challenge. It also comes down to your risk style and how that differs from other people's. So I often see this in couples. We'll have one partner who's more of the saver type, the one that feels a little bit sick when they spend. They can often be the risk averse. So they're the safety warden of the relationship. Doesn't always go hand in hand, but often I do find that with my savers. They're very risk averse. So are you that safety first, or are you a little bit more growth focused? For some, they might be risk averse and that might be their natural risk appetite, but they actually need to take more risk to get to where they need to be in the time frame they have to get there. So think about your risk profile. Does risk frighten you, or are you okay with it? And same for your partner if you are in a couple. So this is not just about labeling you, although we do like to do that with our clients at times. But it's just an awareness, I think, because that can be the first step to you actually making better decisions because you know how you behave around money. So money tendencies, more important than you might think. So 3 things to focus on. Number 1, we want to maximize and save as much as we possibly can. 2 levers we can pull here, guys. We can earn more or we can spend less. But we need to find something and we need to squeeze it out of a stone. A lot of our clients work with us to help them find that blood and squeeze it out of the stone. But we need to get to a point with everybody where we are keeping more than we are spending. So we call that maximize your surplus or maximize your ability to save. So for those of you there that think, I don't know what she's talking about. I can't. There's just too much going on. It's too expensive. I can't afford this. I can't save at all. Don't know what she's talking about. She's crazy. Okay. When you went to the bank and you took out that loan, the bank stress tested that mortgage at a margin, at a higher interest rate than what you're actually on right now. So if it was 5% at the time when you took out your mortgage, they would have stress tested you around the 7% mark. So with interest rates sitting more around the 5% mark, don't tell me we haven't got a little bit of fat built into our budget. You may have had a change of circumstance and potentially there's been a job loss or a reduction in income. For those people, we're thinking about, can we still afford to have this? Is it actually the wisest thing to do to make a big strategic change? And we actually can't afford to have this house anymore and we need to downsize. So either we need to make a big strategic move, or there will be fat that we can find. So maximize your savings is step 1. And these are things that you can focus on regardless of what the headlines say. Step number 2, kill your mortgage. When I say kill your mortgage, I mean, I want you to focus on your non-tax deductible. So if anyone on the call, anyone listening tonight has investment lending, we want to prioritize your family home lending. For many, many reasons, but being mortgage-free and the awesomeness related with that is one of them. But actually, it frees us up to unlock equity and buys us time to build wealth by prioritizing getting mortgage-free on your family home. So that's why we want to crush our mortgage. And the third thing is grow wealth. And this is where you go, how can I grow wealth if I can't even save? So we need to figure out step 1, how can you save? Is it a major change or can we find the fat? Those little inefficiencies where the money goes walkabout. Then we focus on the crushing of the home mortgage. And finally, then we're in a position where we can accumulate wealth. We need to accumulate wealth. And I hope that everyone listening tonight is in KiwiSaver. If you're not, you must join. KiwiSaver is a beautifully slow, incremental way that we tap into compound interest and grow our wealth long term. For many of us, it's not quite enough. So we do need to have that accumulate something for your retirement nest egg conversation with most people. So we're going to talk a little bit about how a little bit later in the session tonight. So I actually met with a couple last week who were lovely. They came to me. They wanted to make some positive change in their life. They were sick of looking at the OCR announcements and worrying about interest rates. So they had a home mortgage, 2 kids. On the surface of it, they were doing, I would say, fine, just fine. They were saving, but it was about $12,000 per annum that they were saving. So not bad. They didn't have short-term debt. It was quite a good starting point, but we dug a little deeper because that's what we do at Enable Me. We don't let you just get away with being average. We want you to actually be awesome. So once we did dig a little deeper with these guys, we actually identified the money that was quietly leaking out. We call that fritter. So we tightened up their structure. We put in place some smarter systems to capture that leakage or that fritter. These guys are now on track to save close to $35,000 per annum. The difference between the 12 that they were saving and the 35 that we're holding them accountable to save was the fritter. It was the inefficiency. It was that money that just leaks. And the thing with fritter, it's little. It's not one big thing. It's not a magic bullet. It's your 1% here, your 1% there. So for these guys, they actually didn't have to sacrifice their lifestyle because we still budgeted in for their holidays and their kids' activities and special events and outings with the children. But we found the stuff that they didn't really care about and we put it to better use. The magic happens when you build the systems that make the behaviors automatic. The goal is to make sure that the money gets caught before it has a chance to disappear. So that extra savings power that we find, it creates options much sooner. And for these guys, it was actually fast tracking their goal of getting mortgage free. They wanted to travel more with their kids. They also wanted to have choices around the work that they do at age 60. So I always say a good plan doesn't rely on human discipline. Systems beat willpower every single time. So when we talk about minimizing fritter, we here at Enable Me believe that most people, on average, most Enable Me clients, fritter or money that goes walkabout, 15% of what's coming in. So the 15% that we find that's going walkabout can be the difference between feeling like you're struggling and actually thriving. Think of it as like controlling the outcome of asking for a 15% pay rise. Wouldn't that be nice? I think if we had the power for that decision, we'd all take it, right? So it can be those little things like the convenient spending, takeaways, the daily coffee, the buying your lunch at work. But it can actually be like sneaky supermarket trips as well. Those subscriptions that we haven't reevaluated, bank fees that we're paying when we shouldn't be, services that you forgot that you signed up for that are silently draining your cash. Get rid of all that stuff. It's unnecessary. It's not making you any happier. One of the other areas that we find where clients are frittering is inefficiency in their mortgage. Restructuring your mortgage and doing it right, or shopping around for better kind of deals in terms of mortgage or utilities, it can create instant savings. And regularly reviewing your structures for everything across the board can actually reveal a surprising amount of extra cash. So let's not fritter. Let's set up the systems to make sure that when we get paid, we have the budget, we've identified the stuff that we want to spend our money on, we've cut out the stuff that we don't need, and we capture that savings as soon as that pay hits your account. We've got to automate that going out, guys, because humans are famously not very good with willpower. So step number 2, once we're smashing it with our systems, get rid of your mortgage. Debt-free housing before retirement is critical. Now, I want you to think about this. And when you did the little poll earlier, you guys said, yeah, I've got a mortgage. Well, 51% of you said, I've got a mortgage and I actually have more than 15 years on the term of that mortgage. How old are you at the moment? And how old would you be at the end of that term? If you're going to be over 65, we've got an issue. A lot of people don't realise that, so that's something for you to do after you watch me tonight. Have a look at that term. How many years have you got left? When will your mortgage actually be paid off per what the bank want you to do? So we've got to get you debt-free living in a house prior to retirement. Accelerating the repayment of your mortgage means we pay less interest to the bank, because paying your mortgage off faster means we hit principal over and above what the bank want us to do. $1 that you pay extra of principal today is $1 less that compounds over time and has you paying more than double of that dollar that you didn't pay off. So compound interest, we know things compound, and interest on interest, that works really well with your KiwiSaver. Not so well on that table mortgage. Works really well for the banks, not for you guys. So less interest, less money paid to the bank equals more flexibility for your future. We're talking actually hundreds of thousands of dollars in mortgage interest if you prioritize paying extra principal off each year over and above your normal repayments, rather in your back pocket than the bank's. Paying off your mortgage faster and paying it with time before retirement, so when we're still working, creates more opportunity to invest, which I'm going to talk a little bit about later. So here are some cold hard numbers for you. And we know that the average age of the first home buyer, this is scary now, guys, the average age of the first home buyer in New Zealand has crept up to age 36. The average term on a mortgage is 30 years. Doesn't really work, does it? We're getting to 66. So this is why I would encourage you to not follow the 30-year term on your mortgage, because a first home mortgage averages at the moment around about $550,000 for the mortgage debt. If you pay that off over a 30-year term, that's over $500,000 of interest. That's not including the principal that you're paying as well. That's just the extra interest you have paid to the bank. So the same mortgage can have a vastly different outcome if we prioritize paying it down. I'm literally talking, if we can pay it in 10 instead of 30, $453,000 saved. Obviously, this is a simplified example, but the impact of that is very, very real. I don't know about you, but I'd rather have an extra $453,600 in my back pocket for my retirement than in the bank's. Thank you very much. But being mortgage-free it's a good goal, but it's not the only goal. It's our gateway to becoming financially free. When we talk about becoming financially free, in my mind, we're in a house, it's mortgage-free, we don't have accommodation costs other than our rates and insurance and maintenance on the property. And we have enough invested so that we don't have to work anymore. And we know that that amount invested is going to last us all the way through our retirement. So for me, that's financial freedom. So getting mortgage free is part of it. And it's a really good goal to have, but it's the gateway to unlock time, to unlock the ability to leverage, and to unlock more freedom and choice. I think of it sort of like in terms of a pathway, not just the milestone we want to get mortgage free, but it is the first port of call. So unlocking equity to build wealth. As you pay your mortgage down, and at the moment, house prices are fairly stable. They're not going anywhere, but they're fairly stable. So as you pay your mortgage down, what you're in fact doing is you're increasing the equity that you have in your home. That equity that you're creating by paying your mortgage off faster is just dormant potential if we don't use it. So when we use that equity carefully and we do the right thing with it, we can actually really move to accelerate our wealth creation even before we become mortgage free. It's the investment strategy that matters more than the asset itself that we could buy with that equity. So I want to show you, and this is you might think it's a confusing looking graph, and I promise that I'm coming to a story in a second, which might be a little bit more exciting than a dry graph, but graphs, this really shows if you do what everybody else does and you get on the ladder at 36, you pay your mortgage off over the 30-year term, we're arriving at age 65 or 66, as the case may be, with only our KiwiSaver. Because if you've only made your mortgage repayments and you've lived paycheck to paycheck and you've floated along and plodded along for that period of time, that is what will happen. So if we can accelerate and even shave 10 years off your mortgage, so do it in 20 years instead of 30 years by paying extra principal every year, this gives us extra saving time, or it buys us more runway, we like to say. We start to run out of runway the closer you get to age 65 or whenever it is that you want to retire. So buying you more runway gives you extra time to invest, to compound said investments to last you longer into retirement. So we have to be a little smarter because unfortunately the system we're operating in at the moment, it doesn't really work anymore. So paying the mortgage debt off earlier is the answer to this broken system problem because it saves you the money and extends your investing time frame. The more time we have, the more compounding we have, the more resilient you are, both now and as you head into retirement. So that's a really good illustration of that. Now, I've been dying to talk to you about these guys because these guys are actual Enable Me clients, current Enable Me clients. They are incredible and they've been through a lot, but they recently became mortgage free. So we actually, with their permission, sat down, interviewed them, and their story's actually on our website. You can go to the website and read their story. While you're there, have a little look around. But yeah, Catherine and John are amazing. So they were late 50s. They came to us. They had, in their words, a big mortgage, and they had a lot of uncertainty around, can we actually retire ever? Are we working till we die? By 2026, they are mortgage free, they are investors, and they have very, very strong buffers, which make them financially resilient. So the outcomes that these guys achieved, so getting mortgage free, investing, so they've got an investment property, they've got their KiwiSaver. At some point, we're going to pay down the debt on their investment property and get them doing other forms of investment like managed funds. The key thing to note with these guys is during the time that they were working with us, Catherine actually lost her job. So headwinds came for these guys. This did not come easy, but she stayed committed. They had the systems. They followed them to the letter. They were amazing. She even had a picture of our little mortgage projection graph that she popped up onto the fridge. That's how strong the goal was for her. And they just didn't get put off from the goals. So life happened for her. They had a period of time where they had to be a little bit austere and pull back. You know, it's a blip. She got another job. Their life carried on. They controlled what they could, and they carried on to be financially successful. So they're still working. They have a little bit more investing to do, but they put themselves into such a better position by becoming really concentrated, focusing on what they could achieve. And to be honest, bless them, they just did it. They just did it. And they've just become mortgage free. So they're feeling the weight completely lifted. They're not worried about interest rates, OCR announcements anymore, which is a place of peace, I can tell you. So this is just giving off a little detail actually to their situation. So initially they were on track to be mortgage free in their 50s. Their mortgage term was 18 years. So we initially projected 7 in that first session with them. They did it in 6 despite job loss. They actually saved $61,000 in interest by paying the mortgage off in 6 years instead of 18 years. And they have actually built that emergency buffer equivalent to 1 year of their spend. So if there's ever another job loss or a reason why they can't work, they've got a year's worth of buffer embedded into their mortgage. So they still live their life. They actually upgraded their cars. They built security and they became investors. So they're very, very happy. So I love this. So this is one of their quotes. And I think the emotional payoff matters. So just as much as the numbers do. So I share graphs. I talk about how much interest can be saved in pie charts. But actually, the feeling, the emotion of becoming mortgage free, I think that's actually sometimes more compelling than the actual numbers and the reason why we should get mortgage free faster. Feeling in control, it removes money anxiety. If you have confidence in your plan, even if you're not mortgage free, but you know you're tracking to be mortgage free, it's life-changing stuff. So I want to talk a little bit about different forms of investment. So for Catherine and John, they chose to do an investment property and they're paying down the debt on that before they're going to build up some other forms of investment. There are many, many, many investment vehicles that you could potentially do. assuming you're mortgage free on your home. Unless you leverage, and that means borrow to buy something else before you're mortgage free, generally with a lot of these things, we have to have the money in the first place. Point being, the right choice for investment vehicle, it depends on you and your situation. What are your goals? What's your runway and your time frame? How long do we have to get there? And what is the level of risk that we need to take to actually get you to where you need to be? When we talk about investing and wealth creation, the investments should solve for your particular problem. We're not trying to follow a trend. But what we do know to be true is if your retirement gap is larger than 300,000, and if you don't know what your retirement gap is and you've got your head firmly in the sand about that, think about how much you earn and how much comes into your bank. So you can do this little exercise. You can hopefully have a pen and paper to write this down. How much comes into your bank account every year? So you can sit down, if it's fortnightly, times it by 26, if it's monthly, whatever. What is the amount that comes into your bank as a family per annum? And how much of that are you saving? If you're saving nothing, that means you're spending everything that's coming in. Let's assume you become mortgage free so you can deduct off what the mortgage payment is per annum. Whatever's left, deduct off what the NZ Super is that the government are going to pay you, and times it by 25. If that number falls over 300,000, it's likely you're going to need to use leverage to bridge that gap, which means you can't save your way out of this problem unless you continue to work for a really, really long time. So if the retirement gap is large and time is short, we often need to tap into leverage. Property is one form of leverage, but it's not the only one. And it's where advice and planning really, really matter, because we've got to get it right if we're going to do something like property. So I want to give a little example, and I know I'm coming back to numbers right now, but this just shows you the power of leveraging, because the beauty of leverage is it's not your money, the majority of it. So for those of you who do find the fritter, you do crush your mortgage and save on thousands of interest not being paid to the bank. You might be able to put yourselves in a position where you do actually have money to invest because you're mortgage free and you're still working. So let's say for this example, we have 160, either you've saved that or it's been a windfall, but there's 160,000 to invest. Option number one, we pop it into a managed fund. For today's purposes, I've done more like what a balanced fund might get you. Obviously, managed funds, just like your KiwiSaver, they go up and down, but generally they can kind of average out. So for purposes of today, I've just used the same growth rate. Some managed funds perform higher, some perform lower. I've averaged it out at 5%. What we do need to take into account when we're talking about managed funds is the fact that we have to pay fees and tax on any returns. So when you're looking at investing into a managed fund, you have to be really careful to go, well, hang on a minute, they're promising me 10% in this fund, but actually the fee's going to be X amount, and then I'm paying tax on that. So actually the net return is coming down to a lot less than that. With property, there's at the moment, no capital gains tax unless you buy an investment property and sell it within the first 2 years. That's called that bright line. So in this example, we have used that 160,000, number one, to invest in a managed fund, and number two, as a deposit on an investment property worth 800,000. Now, I know at the moment it's a hard ask because property values have stayed very flat over the past couple of years. But what we find when we look back historically is that everything goes up with time. And what happens in the property market, it goes really quickly, then it plateaus for a really long time, and then it can go again, and then it can plateau. So we average what those returns are in terms of growth rate historically over time. We've scaled it back a little bit because we don't know what's going to happen moving forward. So with the power of leverage, you've taken that same $160,000 with the same growth rate, but we have two very different outcomes. You see how leverage amplifies the return that you receive because you get to keep the gain on the 5% on the 800,000, which we've calculated to be 37,000, acknowledging that there'll be a little top up over and above the rent that the tenant pays. So that is one benefit of leveraging. Another benefit of potentially considering property as part of your investment portfolio, it allows you to control a larger asset base earlier. It's something we can do ahead of becoming mortgage free. So it's a strategy we can implement concurrently to you paying down your home mortgage. And a lot of our clients do. Oops, I'll go back to my slide. Oh, this is just my favourite saying by Warren Buffett. Just getting mortgage free and accumulating wealth so you can retire, it rewards early, consistent action. Shorter runways, so for those of you who are butting up against retirement, that demands clarity and precision. But like anything, the earlier we start, the better. But if you're starting now, you just take action today. We do not wait. So the best approach for you, it depends on how long we have, what your goals are, the kind of life that you want to lead, the risk you're prepared to take, how much cash we have coming in and going out, and the flexibility of your situation. All of these things matter. There's no one-size-fits-all solution to building a financial plan that gets you ahead, mortgage-free, and set for retirement. Time in the market beats trying to time the market. So what we do here at Enable Me is we coach people in programs to get better with money. We show them how to find that fritter. We show them how to set up the right structures and systems. We show them, and we specifically and unique to their situation, guide them around how much extra principal and how to structure their mortgage faster to get them mortgage free. And then we start to look into the future for them and we understand how they can grow their wealth. But it all starts with an initial consultation. So this financial consultation, I'd like to invite you all to come along, and you can either see me or one of my amazing team members. Actually, it's a really value-packed 90-minute strategy session. You meet with a coach, we get you off the starting block, we highlight where you should be focusing your attention and your effort to help you to get ahead, to get mortgage free and start to grow wealth. We actually, in that session, and this is kind of fun, we compare your current mortgage term to what we think you can do if we optimize that increased trajectory of becoming mortgage free faster. So we kind of show you, if you carry on doing what you're doing, this is what's going to happen. This is how we think you can be better, and this is the time frame for you. And for a lot of people, that is a jaw drop moment. I actually saw a couple today. They were on track to get mortgage free in 23 years. We took it down to 6, and they were just blown away. So I'm really excited to get started with those guys and actually make that happen, like Catherine and John. So we want to be identifying those little inefficiencies and prioritizing critical next steps that we need to be taking. We get a rough sketch. We like to say we're doing the Sharpie view of your financial situation, the beginnings of your blueprint for your financial future. So we are going to extend, I'm hoping, timing-wise, yes we do, we've got some time for some questions, because I think a few of you have been sending them through, and we had some sent through earlier as well. So we do have time for a Q&A, but we would like to extend an offer to those of you who are listening tonight, and that offer is if you would like to come along to one of those financial initial sessions, we will give you that to you for $100. If you're watching this tomorrow, you didn't get a chance to do it on the night, you'll still get that discounted down to $149. We normally charge $400 for those sessions. So absolute bargain. I would encourage you to come along. There's nothing to lose. Come along and see me or one of the team. Let's get this mortgage under control and let's start working towards financial success for your future. So I'm going to ask my lovely producer, Amy, to come online and ask me some questions. So hit me, Amy.
Great, thank you, Shelley. Yes, the chat box was a bit busy tonight. You would have seen all
Yeah, I
those
could see
popping
that.
up. So thank you to everybody who joined us and also joined in with the chat. It was great to see that so busy. So first off, there's something that Bex popped into the chat through the webinar, and a couple of people want to know the answer from that. So she's
Okay.
heard
Good
some
question,
different
Bex. Well done.
she's heard some different opinions relating to how the bank applies the money to the principal and or interest, depending on how you do it.
Mm.
So, is it best to repay increased payments on a fixed rate mortgage, or to save the potential increased amount and pay off a lump sum at the end of the term? So she has used an example. If the minimum repayment is 100 weekly, but you choose to pay off 400 weekly, Or is it better to save 300 per week and pay a lump sum once the term ends?
We want to be hitting it straight away, Bex, because you're actually hitting extra principal. So the bank wants you to make your repayments, and the repayments stretch out over the table loan, generally over a 35-year term or 25 to 30-year term, whatever you choose. The way that they apply the repayments on that table loan is that they apply and pay themselves the interest first. So you don't actually get to the point where you're paying more principal than interest till much, much later, something like year 23 of the mortgage. So as you would have seen, and some banks split it out, and it's so cruel when you look at your bank statement and you see, there's $100 payment, 99% interest, $1 principal. I don't want you to necessarily just increase your mortgage repayments, but I do want you to be hitting extra principal. So if you could find another $300 per week and pay 300 instead of 100, you are actually killing extra principal. And that principal that you're killing, we've stopped the effect of the compound interest. It doesn't get applied to interest. Anything that you pay over and above the bank's table mortgage repayments hits straight principal. So that is how you get ahead. And so do it on a weekly basis if you can. But we want to do it, and this is where we guide our clients around the intricacies of this. We do it via using a revolving credit. So we tend to leave the repayments as they are, the bank's doing their thing, and then we have a little chunk that we attack. And that chunk that we attack, we're killing straight principal. And that stops that compound effect of the table mortgage, gives you the extra interest into your pocket rather than theirs. So it does hit extra principal in answer to your question.
Great. Thank you so much for that, Shelley. Now, another one that was submitted. Can you sign up for a 30-year mortgage term, but pay it off in 10, 15, 20 years without having any fees attached to that?
Oh, yeah, that's what we help our clients do. That's what Catherine and John did. Yeah, so what we do there is obviously there's a 30-year term, but remember there's fixed interest rates. So we look ahead and we go, okay, per your financial plan, this is how much we think you can pay off in the next 12 months, 24 months, 36 months. And we stagger out those amounts, and that's what we hold you accountable to paying off. So we do that by floating the first 12 months, and then we pay back that, and that's our extra principal that we're hitting. And then we have a target for year 2. So we make sure that we have rolling fixed interest portions so that every year you have an extra bit of principal that you can attack. And we do that by using a revolving credit product, because the revolving credit product allows you to pay down debt faster. Because it's floating, there's no penalty to do so, and it builds resilience because you can pull that money back out again in case of an emergency. So it kind of embeds resilience into the way we're paying down the mortgage.
Great. Thank you, Shelley. We're getting quite a lot of questions. I don't think we're going to be able to get to all of them.
Summarise them, Amy, under pressure.
But how much equity do you suggest having in your house before buying an investment property?
Well, I like this one. Yeah. So my hack, and you're going to have to come and see me to actually understand if this is your trajectory, because it's a little bit more complicated than just saying this is how much equity we have. I mean, strictly speaking, assuming you can afford it, I'll use ease of math here. So if we have $1 million house, we need to have 80%. The bank like to have that 20%. So we would have an 800K mortgage. You need to get down below that 800,000 to find that gap to then leverage off. So say, for example, you wanted to buy an $800,000 property, we need to be $160,000 less than the 80% of the value of your home. The caveat with that is you then have to pass affordability. So in an ideal world, my hack is if the mortgage graph says 7 years or less for these clients, then I'm comfortable. I can sleep at night for them doing it. So it comes down to affordability, to servicing, and whether or not it's the right thing for you to be doing at that point, not just the equity in your home for that one.
Great, thank you. Now, one that was submitted before the webinar, is it better to pay a lump sum of the mortgage or have the cash in hand for a rainy day fund or emergency fund, as we like to call it?
No, and I always disappoint people when they come and see me because I say, if you have savings and a mortgage, what you're doing, you're taking those savings, taking a long time to save up that money, you're giving it to the bank on a silver platter. they're turning around and lending it back to you at a margin. So we don't want to do that. We don't want the bank to win. So if you have savings and a mortgage, we need to take those savings, apply them against your mortgage using a revolving credit. So we're getting an instant interest win on the proviso that that can be reaccessed in an emergency. And then we're going to continue to pay down extra chunks of mortgage every year.
Great, thank you. Now, Shelley, I think that's all the time we have for questions at
Okay,
the
it's been a
moment.
very active question
It
box.
has been, and there's a
Right?
lot that we haven't got to. There's a few questions there around ongoing costs of our services. What I recommend is filling out that form, and our onboarding team can drop you a line and you can talk through everything that might
Yeah.
be suitable for you. But anything else, feel free to just email through and we're happy to help.
Yeah,
And
absolutely. And they
yeah,
will give you more information about the Enable Me programs and the offering and what we do here if you fill in the online form. So you can use the QR code that takes you through to a landing page. If you register on that landing page, the team will be in touch basically to give you the information that you require. You're not kind of locking into anything by doing that form. You can then choose whether or not to actually have that session.
that's great. So, Shelley, would you like to
Yeah,
send us
I
off?
would. I would. I've said a lot tonight, but I have a final word to say. Do you want to be sitting here in 12 months' time wishing that you had taken action a year earlier? It's time to break free from the interest rate obsession and move on with your life. Get a plan, stop worrying, take action, and start living. Thanks, guys, and have a good night.